Thank you, everyone, for joining us today. My name is Chun Chun, and I'm with NACBA and the Consultants Training Institute. Before we get started with the Around the Valuation World webinar today, I just want to go over a few housekeeping items. First, to obtain CPE credit, you must answer all the poll questions that pop up on your screen throughout today's webinar. Please be attentive as your CPE certificates will be available within 7 to 10 business days after the broadcast, and you can download those through the nacb.com site. If you have any questions during the webinar today, please use the Q&A option, as those questions will be directed to the presenter and our editor. If you have any technical questions or questions about NACBA, please feel free to use the chat feature, as those will be directed to me. These are our technical editors for the show. We have Wolfgang Niest, Andrew Newman, and Pratik Shah. Andrew will be the one joining us today. And with that, I do have our guest today will be Christopher Mercer, discussing Deja vu all over again, some things we should have gotten decades ago. Just really quick, brief introduction. Excuse me. Chris Mercer is the founder and chief executive officer of Mercer Capital. Mr. Mercer began his valuation career in the late 1970s. He has prepared, overseen, and contributed to more than 1,000 valuations for purposes related to mergers and acquisitions, litigation, and tax, among others. In addition, he has served on the board of directors for several private companies and one public company, excuse me. Mr. Mercer has extensive experience in litigation engagements, including statutory fair value cases, business damages, and lost profits. He is also an expert in buy-sell agreement disputes. Designations held include accredited senior appraiser from the American Society of Appraisers, the CFA, and the ABAR. And with that, I'm going to turn the time over to Chris. Let me stop my share, and then Chris, if you would like to take over, you're more than welcome to.
I'm not seeing anything.
Oh, are you going to share your screen?
Yeah.
Yeah, feel free to. Oh, you're not seeing the Zoom? Click on the Zoom program, and it should pop everything up to the top.
Well, there's nothing here. Let's see. Yeah.
To share.
Full screen.
Not seeing anything?
I'm not seeing anything. I'm sorry.
Do you want me to share and just tell me to put advance? We could do it that way.
Well, we're not going to solve it right now, I don't think.
Yeah, let's go ahead and do that. I'll share my screen then. And then give me one moment. All right. Do you see that slides again?
Yeah, I'm seeing it.
Okay, just let me know when you need to advance, and I'll be happy to do that for you.
The great baseball philosopher Yogi Berra once said, "It's deja vu all over again." I don't know what the "it" referred to, but I'm looking back some 30 plus years now, and I'm seeing the same problems that I saw 30 years ago in the development of restricted stock discounts. So the title of this topic, this program, is Deja Vu All Over Again, Some Things We Should Have Gotten Decades Ago. Could you advance? We're going to set the stage for the demise of restricted stock analysis as most people know it today. And it's not like we shouldn't have known a long time ago, but I think that people sometimes get so accustomed to doing things the way that they've always done things that they forget that there are advancements in valuation theory and valuation practice and valuation standards. Next. So deja vu is a feeling of already having experienced a present situation. The present situation is the current misunderstanding and misuse of restricted stock studies and pre-IPO studies to develop marketability discounts, or DLOMs, if you call them that, to develop to value illiquid minority interests of closely held businesses. Back in the 80s and the 90s, we looked at several restricted stock studies and a few pre-IPO studies to form a basis for developing marketability discounts. And today, sadly, most appraisers apparently still do the very same thing. Next. So beginning in May of this year and through August, I wrote a series of 11 blog posts. I called it Deja Vu. I went back to the SEC Rule 144, pre-1997, as background for restricted stock discounts. I looked at the SEC Institutional Investor Study, the first restricted stock study in 1971. In Deja Vu 3, I looked at Gelman and Trout, two restricted stock studies. That Trout was published in 1977. There's one typo there. The Moroney restricted stock study, the Mayer restricted stock study, the Silber restricted stock study, and the Mandelbaum factors and benchmark analysis. I reviewed what I call the FMV Stout restricted stock database and made some observations about that. And then in Deja Vu 9, I talked about pre-IPO discounts and said they do not provide valid evidence for marketability discounts. In 10, I wrote about a little bit of theory that to point out that valuation theory is the same for businesses and for interests in business. Value is always a function of expected cash flow, growth, and risk. And then number 11, since a lot of closely held companies do pay dividends, can restricted stock studies be used to estimate DLOMs for dividend paying companies? Now I'll be looking at these not in any particular order, but let's go to the next slide. In July of 2021, BVR published a survey about querying appraisers about how they develop marketability discounts. And the upper left, which studies or methods do you use? 90% said they use the restricted stock discount studies. 45% said they use the pre-IPO studies. Nicely, about 49% say they use the quantitative methods of the QMDM and Johnson Park. But 90% are using restricted stock discount studies. Of those, what restricted stock studies do you use? I use the Stout FMV restricted stock study, 76%. So if you're using these studies, which approach do you use? Well, 63% said benchmark average approach. Well, that's we'll see what that means in a minute. And then do you consider the Mandelbaum factors? 66% said yes, and 22% said sometimes. We'll take a look at the Mandelbaum factors. I won't spend any time on it today, but 73% of appraisers would either apply or consider a marketability discount to a controlling interest. And that, my friends, is a discount that does not exist. Next. I've been writing about this for a long time. In 1997, I wrote a book called Quantifying Marketability Discounts, and that introduced what I called the quantitative marketability discount model to the world. In that book, I reviewed all of the then existing restricted stock studies. I knew when I published Quantifying Marketability Discounts that it was part of a bigger valuation theory. And in 2004, I wrote a book called Valuing Enterprise and Shareholder Cash Flows, the integrated theory of business valuation. And I talk about the integrated theory because most appraisers have a fairly disjointed look or understanding of how valuation works. In 2007, Wiley picked us up and we published the second edition, Business Valuation and Integrated Theory, with Travis Harms, my colleague. I call that book the best little valuation book that most appraisers have never read. In 2021, we published the third edition. It's a little bit bigger, but it's still the best little valuation book that most business appraisers have never read. Now, I'm going to be a little bit, let's say, evocative of the book. I would say if it's not in your library, your personal library, you should go to Amazon today and order it. And when you get it, read it, because it will change the way you think about valuation. There is a poll question up. Do I just keep going?
Yeah, you can go ahead and proceed with the presentation.
Next slide. So In response to the BVR survey in the summer edition of 2021, I wrote an article about a current look at a current view of the restricted stock studies and restricted stock discounts. And I said a great deal about that, about what I'm talking about today in that article. If anyone on here would like a copy of that article, you can email me or email NACFA, and we will be sure to get it to you. Also in that edition, the integrated theory was reviewed. Next. So let's start with theory. Valuation theory and standards tell us a great deal about how we should develop marketability discounts. As I said earlier, valuation theory is the same for companies and for illiquid interests. Next. So on the left side, we have an equation. It's a familiar equation. It's called the Gordon model. We call it the fundamental valuation equation. It says that value is a function of three factors: cash flow, risk, and growth. Cash flow in the numerator, the discount rate in the denominator, and growth in the denominator. We use, and I'm quoting right here, Harms and myself, we use the term integrated theory to refer to our rather dogged insistence that the key to answering thorny valuation questions is devoting one's attention to expected cash flow, risk, and growth. So what I want to do in a short period of time is talk about the interrelationships between business valuation and the valuation of illiquid minority interests. Next slide, please. The value of a business is a function of three things: the expected cash flows of the business, the expected growth of those cash flows, and the risks associated with the expected receipt of those cash flows. That's what the Moroney was quoted as saying something like this, that if it doesn't affect the cash flows and it doesn't affect risk, it doesn't have anything to do with value. I've misquoted him, but not inappropriately. The value of a business is a perpetuity concept. We say that the cash flows of the business are discounted into the indefinite future, projected into the indefinite future, and discounted to the present at an appropriate discount rate. Well, what about the value of an interest in a business? The value of an interest in a business is a function of three things: the expected cash flows to the interest as opposed to the business, and those cash flows are derivative of the cash flows of the business, or come from the cash flows of the business. Second, the expected growth of those cash flows to the interest, and that may be different for a variety of reasons than the expected growth of the company. And then the risks associated with the expected receipt of those cash flows to the interest over the expected holding period of the investment. Because you see, the value of an illiquid interest is a holding period concept. It is not a perpetuity concept. People sometimes say, Chris, I don't know what the holding period is going to be, so I can't estimate it. Well, you can estimate it based upon the facts and circumstances that are there. And in fact, you have to estimate it. And in fact, if you apply a standard discount with using a restricted stock study, you have made an implicit assumption about expected growth and risk. Next. The value of a business. This is the basic discounted cash flow model. V0 value today is the sum of cash flows into the future over a finite period of time, the interim cash flows, and then a terminal value at the end of the holding period when the cash flows have stabilized and we can calculate a normalized growth. But value, once again, is a function of expected cash flow, risk, and growth. And this is the basic valuation model. It says, like I said, once again, the value of a business today is the present value of all expected future cash flows to the business, discounted to the present, at a discount rate reflective of the risks of achieving those cash flows. Next. So what's the value of an interest in a business? The value of an interest in a business is the present value of the expected cash flows to the shareholder, to the interest over a finite holding period, plus the expected value of the company at the end of the expected holding period when liquidity is to be achieved. So the right side of the equation is the financial control or marketable minority value of the business at the end of the expected holding period, which basically says that you have to value the business today in order to estimate that tomorrow. Once again, the value of the interest is a function of the cash flows to the interest, the interim cash flows. Note that if the interim cash flows are zero, then the present value to the shareholder is just the terminal value that would be expected at the end at the end of the expected holding period. And the risk, I say R sub HP here, and we used an R in the preceding equation. R sub HP is greater than the R for the business because of holding period risks and a variety of other risks that relate to the shareholder alone, as opposed to the business itself. Next slide. Let's talk a moment about the concept of discounts and premiums. And this is from the ASA Business Valuation Standards on valuation discounts and premiums. A discount has no meaning until the conceptual basis underlining the base value to which it is applied is defined. So a discount relates to a base value that we have to understand. And a premium is the same thing. Now, a discount or premium is warranted on number C when the characteristics affecting the value of the subject interest differ sufficiently from those inherent in the base value to which the discount or premium is applied. So when the characteristics of the subject interest differ from the base value, then a discount or a premium may be applied. And a discount or premium quantifies an adjustment to account for differences in the characteristics affecting the value of the subject interest relative to the base value. Now, we'll see what that means a little more clearly in just a moment, but next slide. I talk about the levels of value and have talked about the levels of value for many years. The current understanding of levels of value suggests that financial control and marketable minority sit coincidental with each other. And that's the base value from which restricted stock and marketability discounts are taken, financial control. You see there's a strategic control and then a financial control. Well, if financial control and marketable minority are coincidental, then the financial control premium is nil and the minority interest discount is nil. Then the marketability discount relates the financial control marketable minority to the non-marketable minority value. So look at the words in the circle on the left. What characteristics at the non-marketable minority level are different than the valuation characteristics at the marketable minority financial control that account for any diminution in value? Go back one slide, please. Because that's what a discount does. It quantifies and accounts for differences in characteristics. Okay, next one. And the next one. So a marketability discount reflects the difference between two prices. It can be expressed in dollars or percent, but it relates to values. It relates the value to the shareholder, and it relates the value at the marketable minority financial control level of value. So we have to determine the value of the company, and we have to determine the value of the interest in the company based upon its expected cash flows. The difference in those two values would be the marketability discount. and it's either expressed in dollars or percent. Next. And why is an illiquid minority interest in a business worth less than its pro rata share of the value of the business? Well, conceptually, think of the value of the business as expected cash flow of the business divided by the discount rate minus growth. Well, relate the characteristics of the business cash flow to those of the interest. Almost always, the cash flow to the interest will be less than the cash flow to the business, because the business may reinvest in the business. The business may pay non-pro-rata distributions to controlling shareholders, or the business may reinvest suboptimally and therefore create lower cash flows for the interest in the business. And then the risks to the shareholder are different and greater than the risks to the business itself, because there's a holding period, which is uncertain in duration, and we don't know exactly how or when liquidity will be available to the minority owner. But as appraisers, we have to estimate that. So remember, once again, a discount or premium quantifies an adjustment to account for differences in characteristics affecting the value of the subject interest relative to the base value to which it is compared. Next slide. Well, what is a restricted stock discount? We've been talking about restricted stock discounts for 35, 40 years. A restricted stock discount is 1 minus the purchase price for restricted shares over the market price for the unrestricted shares of a public company, and the investment is usually made by an institutional investor. So a restricted stock discount could be characterized by 1 minus $7.50, the restricted stock price, divided by $10, the public price that's freely traded, and that would be a 25% marketability discount. Now, let's think for a moment about what that restricted stock discount and that restricted stock transaction tells us. What do we know? Well, we know that the restricted price is $7.50 and the public price is $10, or 33% higher. The public price is 10, the restricted stock price is $7.50, or 25% lower. We know there's a $2.50 difference between those two, but all I'm doing is describing what you're seeing on the screen. There is absolutely, positively no economic information in any single restricted stock transaction, and there is no economic information in 1,000 or any average that you want to make of those discounts. Now, these exhibit numbers that you see are exhibits from Business Valuation and Integrated Theory, 3rd edition. Next slide. Next slide, please.
Sorry, Chris, it like froze on me. Hold on 1 second.
Okay.
See if I can do it this way. Let me try to share that again. Sorry.
Andrew, while this is going on, are there any questions?
Chris, if I may just add a point, while you were talking, I could think of a situation where you would have a discount on the future cash flows, but when it comes to the terminal or residual value of a business, if the money's being reinvested, that discount may not apply to the terminal value per se, and there may actually be a premium because of the of what's been accumulated in the terminal.
Well, let's look at this. Oh, let's go back one more advance. No, go the other way.
Oh,
next slide.
Sorry.
Okay. Well, the value of the business is the present value of the expected cash flows. We will calculate in the terminal value the marketable minority financial control value. And the equation here says 1 plus P/D. And that is 1 plus any premium to the marketable minority value or any discount to the marketable minority value that the appraiser believes would be applicable at that time. So, but it would be the present value of that number, and the discount would apply to that number at the terminal value. I mean, that's just the present value math, I think. Next. 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 Okay, we were talking about restricted stock discounts, and I said there's no economic information in any single restricted stock transaction. Can you advance the slide one, please? Let's look at the question, why do restricted stock discounts exist? On the left, the restricted stock value is equal to the freely traded value, V0, minus the restricted stock discount. And almost always, the restricted stock value is lower than the publicly traded price. Well, how can that be? In the middle, the restricted stock value is lower than the public price, but the cash flows are precisely the same. And the growth is precisely the same. The only reason that the restricted stock price would be lower is because the risks are greater. And so on the third slide, we have an equation that says restricted stock value is equal to cash flow 1. It's a conceptual rendering of it. R plus HPP, or a holding period premium, minus growth. Cash flows and growth are the same. So the only reason that a restricted stock value would be different is that the institutional investors investing in those stocks perceive risks that are greater than the risks of the company itself over the expected holding period. And we'll talk about what that is in just a moment. Next. We had deja vu various, I said. I want to touch on some of the studies that people refer to and in most cases have never read. I call them the old, tired, abused, and misused restricted stock studies. I wrote about all of this or virtually all of this, in Quantifying Marketability Discounts in 1997. So what I'm talking about today is really what I talked about in 1997, therefore deja vu all over again. Next. This table, 25 years later, I found a typo in the table, figure 214 from the book, and it's number 5, the Trout. That's the Trout study. That study was published in 1977. But what I'm saying is that by 1997, when the Trout study and in 1983, when the Pittock-Stryker study was 45%, we had the 35 to 45 came from basically 5 of the 6 studies. The SEC Institutional Investor Study, which was the most rigorous study of all of them, was basically ignored by business appraisers because it didn't have big enough discounts. Next slide. So what were the rules in 1997 and prior to 1997? Well, and why do restricted stock discounts have that name? Because they were restricted stocks. Institutional investors buying them could not sell them for a 2-year period. And then after that 2-year period, they were limited to a dribble out for the next year under the SEC dribble out rules, 1% of the shares outstanding per quarter, or the average weekly trading volume during the 4 weeks preceding the notice of the sale. Well, given that large blocks were typically purchased, it was 3 to 4 years before, effectively, before institutional investors could expect liquidity. Next. So the SEC Institutional Investor Study was published in 1971. It had an average of about 23% market restricted stock discounts. And it showed relationships between earnings, for example, and restricted stock discounts and market capitalization and a variety of other things. But as I said, most people ignored that study after it was published. Next. So number 3, the Gelman and Trout studies. The Gelman study, which has been cited many times, says this. There is a poll question up, so pay attention and get that taken care of, please. The Gelman study essentially said that provided a frequency distribution by restricted stock discounts for 89 transactions. It had a mean and a median of 33%. And that's basically all it said. We don't have detail of the transactions. We don't have any much more information than that. The Trout study, published in 1977, Trout actually tried to create an equation to predict marketability discounts. And this is the equation that he developed. You notice that the RSD is a function of the exchange listing, and New York would probably have a lower discount than over the counter. Shares outstanding. Now, in retrospect, a market capitalization would have been a much better indication there. Percent control, control less than 1%, value, the discount. Okay, standard DVR is 49, so this 0.49, so the standard deviation is about 25%. So this equation could account for about 25% of the variability of the discounts in his study, and his average was about 34%. Once again, honing in on that 35% plus or minus a bit. Next. The Moroney study in 1973. Mr. Moroney did 2 things. He looked at a dozen tax court cases, and he said the average was 25.5% for concluded marketability discounts, and the median was 20%. And he said the market evidence that he found said that the tax court was not being realistic about what marketability discounts should be. So with 146 transactions, he broke it out by fund. As I say, these are institutional investors. Had average discounts per fund, and average was 36%. The median is 33%. Look at the standard deviation, the 18, call it. So it's 33% plus or minus 36% to get 2/3, and outside you got a lot more. Next. Moroney said it's important to look at dividends, although he didn't do much with it. For example, if the marketable minority value were $10 million and the marketability discount was 30%, then the non-marketable minority value was $7 million. Given a dividend yield of $500,000, the marketable minority yield is 5.1. The non-marketable minority yield is 7.1. So what he's saying is that the existence of the existence of dividends should mitigate marketability discounts. And we'll see that they do in just a moment. Next. The Mayer restricted stock study. He had 34, 20, I can't read the number, but he listed some data for restricted stocks. The median was 33, the mean was 35. And then he broke it out by year, and the mean, of course, and the median didn't change any. And then he gave us frequency distribution, and the mean and the median didn't change any. But that's basically all that the Mayer restricted stock study said in 1976. Next. So I put them in a scatter diagram, put this in quantifying marketability discounts in 1997. And I said, okay, these are the discounts in the different funds. And I added Mayer at the end as the last fund, just to broaden it just a little bit. Okay, I can look at that. I have looked at this chart many times, and feel free to look at it and tell me, if you can, that you believe that it suggests in any visual way that a typical marketability discount should be 35% or 45%, or for that matter, anything. Next, yeah. The Silber study. Professor Silber published in the Financial Analyst Journal, and he did a little more than the rest of the guys. He did his study on the left, and he had, I think, 69 transactions. The mean was 34%. Standard deviation was huge. Look at that, 24%. So he had some negative discounts, and that negative discount would be a premium. So block size are big. We got a little bit of earnings. We got the mean revenue is $40 million, and the market value of equity is 54 million, and the average is 34%. But Professor Silber said, you know, I've been looking at the data, and what I see is that instead of having one population of 69, I've more realistically got two populations, one with discounts greater than 35% and one with discounts under 35%. So in the upper right, we have a mean discount for greater than 35% is 54%, with a smaller standard deviation of 13%. Block size is big, no earnings really. Revenues are small, 13.9 million. Market value of equity is 34 million. Look at the right side of that equation, of that table. Discounts less than 35, the average was 14%, with a 13% standard deviation. The prior year earnings, they were profitable. The revenues, they were bigger. And the market value of equity, 75 million. So what you had was really the picture at the bottom. Instead of one great big variable population, a couple of populations that were really much more homogeneous. Now, I wrote about this in 1997. It should have triggered some thinking, but I've never seen anyone talk about the bifurcation of the sample in the Silber study. Next slide. The Mandelbaum factors. Judge Lauro was an interesting man, God rest his soul. He said he didn't like Roger Grabowski's marketability discount, which was 75 or 80%, nor did he like the marketability discount provided by the taxpayers expert, the government's expert. So he said, I think there are, he said 10 factors, but there were really 9, because the first factor, he said, the benchmark range I'm going to use, 35 from Grabowski's marketability discount study or restricted stock studies, and 45 from the other guys' pre-IPO studies. So relative to that benchmark, I'm going to look at financial statement analysis, company dividend policy, the nature of the company, company's management, amount of control in shares, restrictions on transfer, holding period for the stock, company's redemption policy, and the cost of a public offering. And then he said, looking at all of that, he said some are below and some are above and some are neutral. And then he said 30%. Well, in order to get 30%, their implicit calculations, like I've shown here, are important. And in the Mandelbaum factors, by the way, financial statement analysis is already included in the marketable minority values stipulated in Mandelbaum. The nature of the company is already stipulated, and company's management already stipulated. So there really aren't that many Mandelbaum factors, and it doesn't make a lot of sense unless you're actually looking at the dividend policy, the control, restrictions on transfer. And, you know, if you look at those factors, one second. USPAP standards rule 9.4D says, an appraiser must, when necessary for credible assignment results, analyze the effect on value, if any, of the extent to which the interest appraised contains elements of ownership control and is marketable and or liquid. There's a comment, and the comments are binding in USPAP. An appraiser must analyze factors such as holding period. That's one of those. Interim benefits. That's one of those. The dividend policy. And the difficulty or cost of marketing the subject interest. So Judge Laura was foreshadowing a deeper look at the nature of an illiquid minority interest. But it's very difficult to make much sense of some kind of benchmark analysis when the initial range is weakly supported as it is based on what I've said so far. Next slide. Now, we have the FMV Stout restricted stock database. I wrote a book in 2005 called Valuing Shareholder Cash Flows. And at the time, I analyzed what was then the FMV restricted stock database. The analysis is valid today, at least for what I'm going to talk about, even though there have been a number of years since 2004. But because most of the analysis that gets done pertains to the 2-year portion of the database. There are 240 companies in there. There may be 750 companies in the database today based on the BVR website. But you can see those transactions occurred between 1980 and 1997. Now, that's a long time ago. That's 25 years ago for the most recent one. So the 1-year portion, we had 182 at that time. What kinds of companies were these? The 2-year portion, 75% of the companies were in 9 SIC codes. And look at the list on the right, upper right, the 2-digit SIC classifications. Do most of the companies that you value fit that? In the 1-year portion, 75% of the companies are in 5 SIC codes, so it's even more concentrated. Next slide. Okay, the average was about 22% in the upper right, or 23% in the lower right for the 1-year portion. Many people were surprised that when the holding period was shortened, the median marketability restricted stock discount didn't change much for the post 1997 transactions. Well, the reason that is the case is that the companies in the post 97 transactions were bigger dogs than the ones in the pre 1997 transactions, which we'll see on the next slide. Okay, look at these companies, the 248 of them. You've got the average up there, 22%. Market capitalization, 51.6 million in the far right. But I've split things into 6 buckets: transactions at a premium, and then 5 quintiles. You can see that, look at the book value, line 8. Average book value, $7 million. Average price to book, $5.8 million. I can tell you this, I've valued a lot of companies over a lot of years, and I don't value very many companies at 5.8 times book value. Look at the operating margins of these companies. None of them are making money on average, and there's no dividends. There are only 12, there are only just a handful of companies in this group of companies that pay dividends. So what you're looking at is a bunch of dogs and transactions that occurred many, many years ago. And if you are looking at these, you don't know anything about them. What if someone came to you and said, I'm valuing a company at the marketable minority level, and I've got some pretty good comps. And I'm valuing the company at December 31, 2021. But the only market data I have for my public comps is from December 31, 2000. Now, you would not think that that was a very credible analysis, but that's exactly what's happening when we look at the restricted stock studies. Next slide. Okay, what is a pre-IPO discount? A pre-IPO discount is 1 minus the pre-IPO transaction, that's his price. The transaction occurred 6 months or some months before the IPO, over the IPO price. If the price was $6.50 pre-IPO and $13 at the IPO, then the pre-IPO price is discount is 50%. So the pre-IPO discounts were always a bit bigger than the restricted stock discounts. Next slide. Because they're bigger, because they're really a combination of two discounts. There was a pre-IPO valuation, implied or explicit, at say $10 a share, 35% marketability discounts, got the pre-IPO price of $6.50. Now that $10 per share value went to $13 between then and the IPO, or a 30% IPO pickup. So the discount then now to the $6.50 price is 50%. So that 50% discount is a combination of whatever's going on in the IPO, whatever's happening with the pre-IPO pickup based upon new capital, reduced risk, greater potential for growth, and the passage of time. And I don't believe that anyone can discern anything about the value of any illiquid minority interest of a private company today based on a discount like that, or even 1,000 of them. Next slide. This is the distribution of the Emory transactions. This came from the quantifying marketability discounts. Once again, do you see 35% to 45% as any measure of some central tendency? I don't, and haven't for 30 years. Next slide. So what about dividend paying stocks? Total return for investment is the current income, the dividend yield, plus the future upside. Well, let's look at the dividend paying stocks in the pre-1997 transactions, because those prices were negotiations between investors and companies in light of expected cash flows, which included dividends, risk, and growth. Next slide. So there were 24 dividend paying stock companies that engaged in restricted stock transactions. I can almost guarantee that the one up in the upper right hand corner in 1988 with a 38% discount, there's something wrong with that number, because I don't imagine a publicly traded bank would sell stock at a 38% discount, but nevertheless we have that number. The median for the dividend paying stocks, median discount was about 13%, and the average was the same, whereas the median for the non-dividend paying stocks was about 22%. Next slide. So we can look at market value of equity. These companies were much bigger, much more attractive. Book value of equity, bigger, much more attractive. Price to book, 1.7 to 2.2 median and average versus 5.9 or more for the non-dividend paying stocks. So much more normal companies. Next slide. And then finally, we see the dividend yields, 2.3 median, 2.3% median, 4.5% average. Now, my question to you and to anyone is, other things being equal, would you rather have a stock that paid a 4.2% dividend relative to one that didn't? And the answer is obvious, but you can't account for dividends with restricted stock analysis. Next slide. So from business valuation and integrated theory, we have the known studies now. We have information on them. The same 6 that I pointed out earlier are shown in the gray box. And then sadly, I think most business appraisers quit thinking about how to develop marketability discounts back when these studies came out. the die was cast in 1981 when Shannon Pratt wrote about 3 studies at the time and said it ought to be about 35%. Next slide. Most people have never read these studies. Here are the references to them. They were published. I don't know if they're available now or not, but here they are. Next slide. So if restricted stock discounts and pre-IPO discounts don't work, what then? Well, I talk about the quantitative marketability discount model in the book Integrated Theory, Business Valuation and Integrated Theory, where we've developed relative to enterprise valuations on the left, the DCF assumptions, the necessary DCF assumptions on the right. And, their expected holding period, the yield, the growth in distributions, the timing of the dividend, is it end of the year, middle of the year, the growth in value over the holding period, is there going to be a premium or discount, and then some kind of range or estimated range of the holding period returns. Next slide. So the QMDM, and it's available at chrismercer.net/store. Creates an ability to make these kinds of assumptions that are appropriate or necessary when we're valuing illiquid minority interest in the context of the valuation of the business itself. In this case, it's 2 to 4 years, no dividend, a 5% growth in value, 18 to 20% required return. We don't have time to go into formulating these, but you can see at the bottom that the discount, marketability discount, would be 31% for a 2 to 4 year holding period and 60% for a 5 to 10 year holding period. So holding period matters. Next slide. This just relates expected holding period with changes in dividend and the assumption regarding the payment of dividends. And what you can see if you look at this and get a copy of it, and there's another poll question here, that's number 3, I think. So, but shorter holding period, other things being equal, is going to have a lower marketability discount. Greater dividends, other things being equal, will have a lower marketability discount. The problem with dividends is that unless you make calculations, you can't understand or you can't articulate their impact on value. Next slide. So make a few calculations with the QMDM. On the upper left, a 2 to 4 year holding period, 6% yield, 5% growth in value, and 18 to 20%. Got a 17% marketability discount for the 2 year. We had a 9% yield in the one on the on the right, and that would lower the marketability discount to 10%. So the greater the yield, the more attractive the investment, the higher the price for the illiquid minority interest. Next slide. So deja vu all over again. These blog posts are available at chrismercer.net. I encourage you to take a look at them. There's more detail there than we've been able to talk about in this session, but in any event, I commend them to you. Next slide. And so if there are any questions, Andrew, I'll try to address them now. If anyone wants the restricted stock article that I published in Business Valuation Review, let NACBA or just email me and I'll get it right away to you.
Chris, if I may ask a question, if there are no questions from the audience, in terms of the holding period, what type of inflation rate is assumed in that calculation? Because I would think that that would have a significant impact on the amount of the quantum of the discounts.
Well, the inflation would be considered in your buildup of the equity discount rate for the company, and that would and the equity discount rate for the company is the base discount rate for the shareholder level. So you've already considered inflation.
There don't appear to be any questions.
I don't see any other questions either. There were some concerns about the slides, and I will get that updated in the link. So if you go to nacb.com, log in, and then go to around the national, the new link will be updated a little bit later on today. Apologize for the confusion there. There is Chris Mercer's bio. Before we end, Chris, but Andrew, do you guys have any other last minute items you wanted to just cover?
Not at this time. I think Chris did a fabulous job in terms of addressing the matters with regards to the discount rate, holding period, dividends, and the implication of dividends and so forth.
Yep, that does a great job. Thank you, Chris, for joining us today. I know you.
Thanks to all who've complimented me by chat. I appreciate it.
You always do a great job. Thank you.
Okay.
And thank you, Andrew, for joining us. Looks like our next one will be on January 30th of next year. So we will see everyone next year, I guess. All right.
Happy New Year to everyone.
Yes. Happy New Year.
And happy holidays.
Okay.
Thanks for joining us, everyone. Goodbye.